Welcome to the Explainer. So let's dive right into this, because we're looking at two absolutely massive, highly strategic upgrades coming to the Indigo protocol ecosystem. Now, if you need a quick refresher, Indigo is a top-tier synthetic assets protocol over on Cardano. It lets you trade real-world and crypto assets seamlessly. And today, they're leveling up the entire system in a big, big way.
Indigo is evolving, and it's doing it fast. They're moving out of that initial growth phase and maturing into a highly self-sustaining financial platform. Today, we're going to break down exactly how they're maturing the protocol's underlying economy, and more importantly for us, how they are significantly expanding your trading toolkit. We'll look at the nuts and bolts of these updates and what they actually mean for the broader DeFi landscape.
So are you ready for a completely new iADA strategy? What about sustainable, real yield? To really appreciate how huge this is, we kind of have to talk about why moving away from traditional inflationary rewards is essentially the holy grail in DeFi. Historically, a lot of protocols just incentivize users by literally printing new tokens out of thin air to hand out as rewards. But obviously, that naturally dilutes the token's value over time. What Indigo is doing right here is totally abandoning those old inflationary mechanics and pushing straight into a real yield economy. That means the returns are generated by actual protocol usage and fees. Let's get into exactly how they're doing it.
Section 1. iADA, a new ADA strategy.
All right, let's start with the first major feature update on our plate, the introduction of iADA. This is a brand new, highly strategic synthetic asset within the ecosystem. And right now, this asset is officially live for voting on Clarity, which, if you didn't know, is Cardano's primary decentralized governance platform. The community is actively casting their votes to officially bring iADA to life. This is a huge governance moment, right? It really highlights the decentralized nature of the protocol in action. The users themselves are literally turning the gears to approve what's going to be a foundational new tool for anyone looking to optimize their Cardano holdings.
Moving on to Section 2, shorting and stability pool yield. Now let's break down exactly what you can actually do with iADA once it's implemented, because it unlocks some incredibly specific utility for your portfolio. Basically, we're looking at two primary strategies here. On one hand, you've got strategy 1. You have the option to borrow iADA against USDCX, which is essentially a synthetic stablecoin pegged to the US dollar in the Cardano ecosystem. By borrowing iADA against that stable asset and then immediately selling it, you're effectively shorting iADA. So if the price of iADA drops, your borrowed debt becomes cheaper to repay, and boom, you profit. That is a massive capability for traders who want to hedge their current holdings or capitalize on downward market momentum. On the flip side, we have strategy 2. You can just buy iADA on the open market and use it to participate directly in the stability pool. Now, the stability pool is the backbone that keeps the protocol solvent. It's a reserve that absorbs and liquidates risky debt positions. By providing your iADA there, you earn a real yield plus liquidation premiums. Those premiums come straight from the fees collected when under-collateralized positions get closed out. So whether you're an active trader looking to short, or you just want some passive earning opportunities by providing stability, you've got some incredible flexibility now.
Section 3. Independence from token emissions.
Now, beyond just expanding your strategic options with new assets like iADA, Indigo is fundamentally changing its underlying economic engine. To really grasp this shift, we have to look at how the protocol is moving completely away from standard token emissions. Like we touched on earlier, the old way of doing things in DeFi basically relies on a money printer to attract liquidity. And let's be real, that's just unsustainable. So instead, Indigo is shifting to a model powered by real interest accrual. The yield you receive will be powered by iAssets accrued from actual interest paid by borrowers inside the system. This directly replaces those old inflationary emissions. Think about that for a second. Instead of your rewards actively diluting the total supply, you're now earning a slice of actual, genuine protocol activity and revenue. It is a massive, massive upgrade in economic design.
And they had a bit of clever timing with this milestone, too. Fittingly, they announced it right alongside the US Independence Day. The protocol is basically declaring its own independence from relying on token emissions. But hey, it's really important to recognize that this is way more than just a clever marketing gimmick. Halting emissions and relying strictly on real yield, that is a technical and economic milestone that so many DeFi protocols strive for, but very, very few actually achieve. It proves that this maturing platform is stepping firmly into a self-sustaining phase. Its core product generates enough real demand to reward its participants without ever needing that printing press.
Section 4. Your interest accrual timeline.
Now, it's great to understand all the underlying theory and mechanics, but knowing exactly when to act is absolutely crucial if you want to apply this to your own strategy. So, mark your calendars. The new interest accrual officially kicks off on July 4th.
From that exact moment, the real yield engine is running, and interest from borrowers starts accumulating for the providers. Then, just a few short days later on July 9th, user withdrawals for that accrued yield officially open up. At that point, you can jump into the protocol's interface to claim and withdraw the real yield you've generated. That is a very rapid rollout for such a foundational change to how the protocol operates.
I actually love how the Indigo team wrapped up this announcement. They brilliantly signed off with, "Let freedom accrue." It's a fun sentiment for sure, but it perfectly underscores the core philosophy of this whole update. It's entirely about letting that sustainable, non-inflationary financial freedom build up within the protocol over time. Moving away from artificial incentives and shifting toward genuine economic value, that is exactly what makes decentralized finance so powerful in the long run.
As we wrap up this explainer, I really want to leave you with this question to chew on. Which new iADA strategy are you going to deploy first in this newly independent protocol economy? Are you going to utilize USDCX to take a short position on ADA to hedge your bets? Or will you jump straight into the stability pool to capture that real, sustainable interest yield? The tools are now in your hands to build your ultimate strategy. Thanks so much for joining me to unpack these updates. Keep learning, keep exploring, and I'll catch you on the next explainer.